with Joachim Svering, Principal Economist at DG Grow at the European Commission, with Anka Bogdana-Rusu, Head of Strategy at C Labs, which is part of Silo, an open blockchain platform, a payment infrastructure. We are going to also have with us Maria Teresa Chinienti, Senior Financial Sector Specialist at World Bank, and also Paul Worthington, a Public Policy Manager for Europe at Nobi. And we'd like to take again this opportunity to thank Nobi for allowing us, giving us the opportunity to do this call for papers and the webinar today. But without any further delay, I'll pass the floor to Peter. Peter, I had the opportunity, of course, to read your paper, which I found very interesting and very good quality, because what I see is that, you start with a basic fundamental question, thinking about CBDC in terms of market failure. And as I said also, what is the reasoning for central banks entering this marketplace and how they should be done this one? And the second, what I found very interesting about your paper was also that you look a bit from the microeconomic perspective, because so far the focus has been more on the macroeconomic. And you do a very important distinction between payment object and payment systems. But I'm not going to take any further time. I'll pass the floor to you, Peter. Happy to present and see your presentation.
Yeah,
please, Peter.
Thank you very much, Apostolos. Thank you very much, Carol, for awarding us this prize. It's a great encouragement for us. And Thomas and I are now happy that we can present you our paper. And for this, I will share my screen. It's here. Okay. Okay, so you can see everything?
Yes, but can you enlarge it? Put it on the full screen mode?
It is on full screen, should be on full screen. Not that my computer is on full screen. I don't know why. Okay, and just one check. So maybe on this screen we have to enlarge it.
No, it may take there might be some lapse in between the systems. Yes. If you try again.
Now, okay. Is it now better?
No. I think you have to put on the top right bottom of your screen. I think the third or the fourth option there to put it in a full screen mode.
On the right corner next to the enlarger.
Right corner next to the enlarger, right?
There is a slideshow. If you click on that, then it will be on the slideshow mode.
Now, okay. So you don't see anything, or you do only see it not in full screen?
We don't see it in a full screen, but you can continue. Peter, it's okay.
It's better. I don't know.
Now it works.
Okay.
That's it.
Okay, great. So sorry about this. Okay, so as Apostolos already said, our approach is a microeconomic approach, and we started first with the motivation of central banks for CBDC, and there are many surveys now, especially from the BIS, and the main motivations for central banks are payment safety, payments efficiency, financial inclusion, and also monetary sovereignty of Europe in relation to US payments platforms. And so the question is, in how far can these CBDC solutions contribute to what central banks want to achieve with CBDC? And as Apostolos said, our approach is microeconomic because there are so many publications on CBDC, but they're almost all from a macroeconomic perspective, asking questions like digital bank runs, like disintermediation, like effectiveness of monetary policy. Our approach is, first of all, we have to find out whether CBDC will be adopted at all and which design they have before you can start the macroeconomic discussion. In our view, the important thing with CBDC is that they imply a qualitative leap for central banks. It implies that central banks start to compete with the private sector. This is something different because so far central banks are only monopolistic suppliers of banknotes, and so competition is not something central banks are accustomed with. And from this microeconomic perspective, there are two main questions. First, is there a market failure that justifies central bank activities in the sphere of private banks and private payment service providers? And also similarly important, the question, can CBDC solutions compete successfully with existing payments asset and payment systems? And before we go into the details, I think it's very important to define what do we understand with CBDC. And we think there's a huge confusion in many, many publications. And therefore, before going into details, we think it's important to differentiate between payment systems, payments instruments, and payment assets. We have here some examples. I will not go into detail, but in the cash payment system, you have the banknote as a payment instrument and the banknote as a payment asset. So in this cash payment system, everything coincides, but this is different in all other payment systems. For instance, in the commercial bank system, the payment asset are the bank deposits, payment instruments are bank transfers, debit cards, check, online payment, and so on. So when you talk about CBDC, it's important, what do you have in mind? Is CBDC a payment system, a payment instrument, or a payment asset? And definitively CBDC is not a payment instrument, because as it is something digital, you need payment instruments like online banking, like wallets, like anything, but CBDC can never be a payment instrument. So the question is it a payment system or a payment asset? And for this, we tried the following differentiation. When you design CBDC, you can design CBDC in a way that it is only a payment asset, kind of bank account with a central bank, but it is not necessarily a new payment system. So this is this, So this is this field here. So, and these solutions are called hybrid CBDC, indirect CBDC, intermediate CBDC, and we'll discuss it in more detail. But CBDC can also be a new payment asset that comes together with a CBDC retail payment system. And that's what is called direct CBDC. And of course, one can also ask the question, do we really need a new payment asset? Or is it a new payment system, a European payment system, what we need? Which does not necessarily require a new payment asset. And this is something one could discuss as a kind of European PayPal, which does not necessarily be provided by central banks. So we have now these different cases, and we can discuss now go through these cases and ask how will the competition be between CBDC and the existing solutions. So if CBDC is only a new payment asset, then the competition is with private bank accounts. It's deposits on private bank accounts. And there are two solutions, the hybrid CBDC, which is a kind of payment CBDC, and there's also the possibility of intermediated indirect CBDC, where CBDC more or less has the function of a store of value. And if CBDC is a new payment asset and a new payment system, then the competition is with the cash payment system on the one hand, and the private retail payment system, private retail payment systems on the other hand, and that is what is called the direct CBDC. And the question is now, in these different areas, will CBDC be attractive enough to compete with the existing solutions? And the question is also, where is the concrete externality, the market failure that would justify that central banks enter into this competition with CBDC? So let's start with the hybrid CBDC, and we are using here the charts that are provided by the BIS. in its publication. Hybrid CBDC means CBDC is a payment asset provided by the central bank. It means that private households can have a direct account with the central bank here. But the central bank does not provide a new payment system. All these CBDC deposits are handled by private payment service providers. And then the question is, what is the attractiveness of this approach? And one could say, well, the main feature of deposits with the central bank is that they are absolutely safe. This is something which is special. But as you all know, with the deposit insurance schemes, all bank deposits below 100,000 euro are protected and are also absolutely safe. So the specific advantage that the central bank account might have does not matter, because deposit insurance makes all deposits below 100,000 euro, makes them safe. And so the question is, if the central bank account is as safe as the bank account, what should be the incentive for private households to use this account? And we don't see any reason why households should do this then, because it requires for them to have not only the central bank account, but also a commercial bank account, because the CBDC account is relatively rigid in that it has lower and upper limits, so you cannot have a negative balance on the CBDC account. And as the ECB envisages it, there's an upper limit of 3,000 euros. So for households, in our view, it's not a very attractive solution. And if you have the broader objectives that you want to improve payments efficiency, payment safety, and anonymity, we don't see any advantage, because in this form of CBDC, you have all payments handled by private payment service providers. So this does not make a major difference. So all in all, as far as hybrid CBDC is concerned, there is no evident market failure that we see right now, and we don't see any benefits for users. A relatively similar solution is what is called intermediate CBDC. And intermediate CBDC means that the central bank is no longer holding individual accounts of households. They are only holding accounts of the payment service providers that offer accounts to households. So it's no longer individual deposit with the central bank in this CBDC version. And we are not even sure whether this is possible at all from a legal perspective. But this design is, in our view, not more attractive than the indirect CBDC. And yeah, overall, it's more or less the same, but it has the advantage from the perspective of households that they do not have the direct access to the central bank, which CBDC proponents regard as a main intention of CBDC. So, and then the third form that we can talk about is indirect CBDC, which is a solution if you have a payment system with stablecoin intermediaries. And so in this design option of CBDC, households have only accounts with the intermediary, with the stablecoin provider. And for the stablecoin providers, the bank account, central bank account, is a coverage for their liabilities, and the direct connection between households and the central bank no longer exists. We think that this is a quite interesting option if you have more and more stablecoin providers, because this form, the stablecoin providers have a direct link with the central bank, and it's a form where the central bank can also exert some regulatory influence on the stablecoin provider. And interestingly, the Libra Association in 2020 said, we want this form of CBDC, because this allows us to have a reserve for our liabilities and to always ensure that we can fulfill our liabilities. So I think that's interesting, but one has to be clear, this is not the original idea of CBDC, because it's not for payments. The CBDC is only kind of store of value for the stablecoin providers. So it's interesting, but it's not what the central banks really seem to intend right now. So let's come finally to the direct CBDC. And direct CBDC means that CBDC is provided as a payment object, and the central banks at the same time develop a CBDC payment system which handles the payments with the CBDC objects. And in this design option of CBDC, we have two forms of competition. On the one hand, CBDC competes with the cash payment system, with the existing cash payment system in the form of digital cash. And at the same time, it competes with existing payment platforms. The question is, will CBDC compete in these two areas? We think that a CBDC payment system has many disadvantages compared with the cash payment system, because people who make cash payments today are very much interested in the absolute anonymity of cash payments. And so far, what we have seen so far is any form of CBDC cannot be as anonymous as cash payments. And also the robustness in extreme events that is often mentioned, especially by the ECB. We think that cash payments is always superior, because for cash payments, you don't need electricity. And we've seen from natural disasters this year in Germany that in extreme event, you no longer have access to electricity, and then all these digital payment forms do not function. The other form of competition is competition of the direct CBDC with private payment service providers, PayPal and credit cards. And the question is, can a CBDC payment system compete with these private payment platforms? And here we are also skeptical, because what makes the attractiveness of PayPal and other platforms is that for these payment systems, you do not need payment assets that are held in the payment platform. So to make payments with PayPal, you don't need to have an account with PayPal. PayPal just takes money from your bank deposit or wherever. And so I think that's the main advantage of modern payment platforms, that they are not linked to specific payment assets. And the CBDC platform would always require that you have money in form of CBDC assets in order to make the payments. And so again, it's kind of parallel structure, which is associated with relatively high transaction costs. And in addition, these private payment platforms offer a variety of services for retailers and customers. They have the advantage they can be used globally, and they can also be used in different currencies. So we see no chance at all for CBDC payment system to compete with the private payment service providers that are existing right now. So again, it comes to the same conclusion. We don't see where we have today market failures in terms of payment systems. We can even say we never had such a broad spectrum of payment service providers as today, and there are also no clear benefits for the users. So let me come to the end. So we can ask, can CBDC achieve the objectives of central banks? And in terms of payment safety and payments efficiency, if you have an indirect CBDC, where CBDC retail payments are handled by private service providers, there is no change compared with the status quo. You have just PayPal using your CBDC assets in order to make payments. So that's no fundamental change in the payments landscape. And if CBDC is designed as a direct CBDC, which means it comes with an independent CBDC payment system, we do not see the unique selling proposition over private service providers. as far as financial inclusion is concerned, we did not talk about this, but so far all CBDC options require a commercial bank account. So if you are unbanked, CBDC does not mean an improvement for your payment programs. And so the better solution, which already exists, is mobile phone banking systems like the M-Pesa system in Kenya. And so if financial inclusion is you want to achieve, in our view, CBDC is not really providing a benefit. And finally, what is really important, and which has been raised in recent papers by the ECB, monetary sovereignty, monetary autonomy of Europe. I think this is a very important target. It means that we in Europe want to become more independent from international payment platforms that are providing us as payment services. But if this is the aim, and I think this is something which is really worthwhile to achieve, the question is whether CBDC can be the answer or whether we need a private payment system that can successfully compete with PayPal. So we don't need, in our view, new payment assets, European payment assets. We would need a private payment system that can successfully compete. And here it's quite interesting to look at the experience in Switzerland, where the twin payment system has been developed in the last few years. And it's really amazing how successful twin has been so far, also in competing with PayPal. You can see in Switzerland, the market share of PayPal is relatively low compared to twin. So to conclude, in our view, all these efforts to develop CBDC in Europe, to develop digital Europe, in our view, they go in the wrong direction, at least as far as retail payments are concerned. And if retail payments are the concern, then the solution is to develop successful private payment systems, which must have the same attractive features as their competitors from the United States. Thank you very much for your attention.
Thanks a lot. Thank you very much, Peter, for this very interesting presentation, and all the different options, all the different models are very useful. I have one quick question. I mean, China seems to be at the forefront of the development of CBDCs. Do you know what model do they use? Do they have a type of direct, indirect CBDC, or do you have any idea of?
Well, I think in China,
although China is very different, the model there. I mean, you have a lot of things to consider, rule of law, competition, privacy. There is a lot of things, but please.
Yeah, so I think in China, obviously, the motivation is to reduce cash payments, to get more information and what the citizen and households are doing. And in my view, it must be a direct CBDC as much as far as I see it, that competes with the other payment systems. And of course, in China, they have tried to make it attractive, for instance, by making lotteries when you open an account with CBDC. But the intention here is obviously quite different one than the intention of central banks in other countries. I can't hear you.
Yes, thank you, Peter. Joachim, on your side, how do you see that? What is your initial reaction? And also, what is the perspective of the Commission on that?
I can tell you what my impression is on this, because I do not speak on behalf of the Commission, but give you my personal thoughts. But first of all, thank you so much for putting this panel together, which is a very good one. And I'd like to congratulate actually Peter and Thomas for the excellent paper, because this really brings a lot of sense into the discussion. There are so many discussions we have on CBDCs these days, and nearly every day you read in the press a new exciting announcement by someone to launch a few things, but it is high time to bring some economic sense into this discussion, but also be a little bit more philosophical, I would say, on this. I speak on my personal account. As I said, I'm responsible in DG Grow for the development of the token economy, but also for digital skills development. And I'll try to bring also this second aspect a little bit into the discussion here. My initial reaction, very briefly, is along three lines. First of all, centrality versus a decentralized approach. Second, where are the use cases? And third, indeed, the role of learning in order to understand and foster innovation. Now let's look a little bit back. Let's go back 12, 13 years when a lot of things started, financial crisis. We had all the systemic risk in the banking sector. You know how the Commission did a hard and I think good effort in order to stabilize banks, and also then afterwards looked for alternatives. And then we started the policy work on this whole pipeline that emerged on the market: crowdfunding, alternative finance, fintech, blockchain, now tokenization. And the bottom line to all of this is that it completely changed the perspective on policymaking, but also regulation. It was not a top-down approach any longer, it is a bottom-up approach. And the basic thing about blockchain, what we're discussing here, is that it is decentralized. It is what people want to develop because they feel that, I would say, the big impetus that innovation can create and the big opportunities lie in decentralization, lie in democratization of financial markets, but also much broader of that, actually a philosophical approach in order to take responsibility for your own economic and social life. And so whatever solution we are discussing that is not decentralized, but centralized, as the name CBDC said, is fighting an uphill battle. Because, as I said, the innovation driver is the decentralization throughout blockchain development. And now to bring in a central entity in order to do things that also decentralized entities or less centralized entities can do is a very difficult starting point. And this creates what Peter has already explained, the trust problem. This raises the question of the incentives, and therefore I like the microeconomic approach very much. In whose benefit is it actually? Would it be in the benefit of citizens or enterprises that already now have a broad spectrum of alternatives in order to raise finance? Or would it rather serve the interest of central identities in terms of control, in terms of other policy objectives? And there I think China is a very good example, actually. I'm not commenting on China, but we all know what the business model behind this is. And this is not only centralization, it is control of citizens. And this is something that we very much do not have in the European Union according to our values. If you look at all our work on data, for example, starting from the GDPR, our other aspects, we always put the individual in the center, and then the individual, the citizen, the organization starts to decide to whom do I give my data, with whom am I going to interact, and therefore I would say the burden of proof is on a central entity in order to show that they can do things better. The second thing is when we are discussing tokens or blockchain solutions, what is the use case? 6 years ago, the Commission made a very bold statement. We looked at the innovation priorities of the European Union, and we looked very broadly and decided that blockchain would be one of the 4 breakthrough technologies that we would like to develop in the future in all different policy fields. And I, at the time, proposed blockchain, but I proposed blockchain not as such for payments or for financial matters, but for applications in the real economy. Cryptocurrencies are nice. Crypto assets are nice. All of this is very exciting. But when you come from a public side and put resources into this, manpower, finance, all sorts of other things that we do, you have to prove that there is a benefit to the citizens and to the enterprises. And in my opinion, this exclusively lies into the use cases that industry, that SMEs, that citizens can develop. And therefore, I like very much the tokenization of money in terms of a functionality. Not only the payments, but also when it is encoded, at the same time, the investment function. You invest, for example, in a tokenized machine. You can use it for shorter rental or other business models that are very cost-saving and are very innovative. And then as soon as the engine is switched off, you have settled the finance, the payment, the insurance, the bookkeeping, everything. This is being done by tokenization. And this is why we like and support the token economy. This can be perfectly well done with, I would say, wholesale solutions, which we are very interested in, with other forms of crypto finance, cryptocurrencies, etc. And indeed, the question is, where would be on top of that the use case for a completely CBDC solution in a centralized way? And this is at the moment very difficult to see. So I think that the biggest potential of what we're discussing here in terms of digital finance indeed lies in programmable money, but it lies more in wholesale versions of programmable money, or sort of use cases developed by associated enterprises together with some financial intermediaries, can be banks, can be non-banks. So there's a lot of competition in the market to see what actually drives the development. Last point, what would then be, if we fail to see at this moment the concrete use case, the benefit for central authorities to come in? And I think in the Commission, we've done that in the past. We have developed a lot of policies around blockchain, around the, I would say, not only the mapping, but also the financing, the idea finding, the support for all sorts of decentralized solution. And in my opinion, one key benefit that also plays a role here and hasn't been discussed yet is co-learning, is private and public co-learning. Because the technology as such is developing so quickly that it completely outpaces any sort of traditional regulatory work. You cannot simply spend years any longer to design a framework for regulation because the market completely outpaces you. And therefore, you have to turn from a preventer into an enabler by accompanying the market, by thinking in terms of co-learning, of sandboxes, of understanding the technology, of working yourself on use cases to see how you can drive innovation and the application of that. And there I see a very big role, not only of organizations like the Commission and others, but also of central banks in order to simply develop their own human capital in order to understand what markets are about, what really nowadays drives markets. And what nowadays drives markets is not what you find in neoclassical textbooks. This is completely wrong, because we do not have atomistic competition. We do not have other things. Blockchain decentralized is about communities. It is about decentralized community management and what drives them. And all entities that are governing this process from a public side need to understand that and work on it. And this is why I would very much like central banks to come in much more into the discussion, but again, as enabler, as having a positive statement like the Commission did 6 years ago that yes, blockchain is not just another technology, it is a game changer. We love the technology, it has so many opportunities, let's develop it. Let's also work ourselves on this. And indeed, Peter said something very important. Let's try perhaps from a central bank perspective also to understand ourselves as a sort of competitor. It's not nowadays so that one central entity any longer defines what is going on in the economy. We are way past these times. And so you have to justify every day your role as a central entity, and that can only be done by doing positive things and not by, let's say, working on solutions that, in my opinion, it's very hard to find a reason why the market needs it.
Thank you. Thank you very much, Joachim. I hear your positivity and the variety of payment solutions. Payment system is good. Decentralized market-driven innovation is attractive for the market, will be good also for consumers. And with that said, I would like to go to Anka. Anka, first, I would like to say a few things. What is C Labs? What do you do? And also, if you can briefly explain what is the difference between a CBDC and a stable coin, and what are the advantages of disadvantages of the one compared to the other? Because also what Peter said and described, I mean, it all depends on how a stable coin is designed. If you have, let's say, a stable coin where is a 100% backing by reserve held at the ECB, this is a kind of a definition of a narrow bank. And then it's completely different if you have a stable coin, which does not have 100% reserve backing, but it's backed by something else. So everything depends on the design of the stable coin. But please, Anka, the floor is yours.
Thank you so much for that. And I would also just very selfishly take away from Joachim's presentation that the European Commission thinks that cryptocurrencies are nice. That's going to be my main takeaway from all of that. Thank you so much for organizing the panel and Pierre for the paper. I want to say it's great to see this paper. I think we run into conversations about implications of CBDC without stopping to think what a CBDC is. We see, we use and throw around this term very loosely a lot of times, and different people mean very different things by it. And from there, the conversation is just, it's not constructive because everybody has different designs and different ideas. So to be able to see papers that come out and look at what is a CBDC, conceptually, what are the different ways that you can think about it and design it, is very useful, right? Because I think we see a lot of e-money alternatives that are being referred to as CBDC. To briefly answer your question, C Labs is the software company that incubated and helped launch the mainnet of the Celo blockchain. Celo is an open blockchain platform that is mobile first and really aims to make financial tools accessible to anyone with a basic smartphone, and due to more recent integrations to folks using a feature phone, so USSD standard. On the Celo blockchain, there are a couple of stable coins that have been launched. The Celo dollar, which is pegged to the US dollar, the Celo euro, one of the so far very few euro stable coins that have been launched. And soon enough, the Celo Brazilian real, which I don't know if you've announced publicly yet, but I'll trust this is all in confidentiality. I think it's really important, again, to go back to definitions, right? A CBDC, the way that I see it, is national fiat minted on blockchain by a central bank. How then it is distributed, it's a very different issue, right? Is it direct? Is it indirect? What layer, how that's distributed, it's a different question. A stable coin is generally a cryptocurrency or a digital currency, it doesn't have to be encrypted all of the times, that is in some way pegged to a standard. And that standard can be national fiat. It can be the price of a commodity. And we've seen more recently gold price pegged stable coins. It can be pegged to a basket of goods and services and a price index. And so there's wide variety there. There's wide variety as well when we talk about the composition of a stable coins reserve. And I would push back a little. I think there are a lot of crypto reserve assets, crypto-backed stable coins that have reserves that are typically over-collateralized. We see this more with the ones that have on-chain reserves than the one that have fiat reserves. If we're talking about some of the big players in the market, DAI over-collateralized at 150%. For Celo, it's actually closer to 500%. And this is necessary because of the instability of crypto assets, but it is capital inefficient. And so we are talking about just really, really wide variety from reserve assets backed with cash and cash equivalents, such as Tether. I have some thoughts about why that might be very limited in visibility and probably not the best idea. And to the ones that are algorithmic backed by on-chain reserves. One thing that I would argue as we go into what is, is there a market failure for a CBDC to exist? I would argue that right now, especially in most of the OECD countries, there isn't. But as we do see an increase in tokenization of the economy and a lot of other assets being brought on chain, I'd almost want to argue that a CBDC carefully thought about and designed could act almost as a base settlement layer that is risk-free for everything else that can be developed on chain. It's almost, the CBDC is the base layer in terms of being risk-free. You then have stable coins that are pegged to the on-chain CBDC. And then you have, bonds linked to it, flash loans, all of the derivatives that we see right now in the capital market, sort of increasing in the amount of risk and exposure. But that you would want a CBDC to be able to have that risk-free settlement layer. If we're talking about the mission of a central bank, I do think that evolves. And I very much agree with Joaquim that even if most of the central banks that are now testing and playing around with the idea of CBDC do not end up issuing one, it is fundamental that they test, because it is only out of a place of knowledge and understanding of the technology, of the potentials, of the use cases, that they can be efficient in regulating the market without killing innovation. And I think perhaps that is one of the most important things that central banks can do in the realm of digital assets right now. The only one other thing that I wanted to briefly touch upon is there's a study that I think was launched today by OMFIF and GND that looks at a survey between emerging markets and developed markets and the appetite for CBDC end users to use such an instrument. And obviously in places like Germany or the US, where you have a wide variety of options, the appetite is much lower. If you look at Indonesia or Nigeria, on the other hand, you do see people finding value in a CBDC. Cash is nice. And in Europe, it's easy to find. If you go to places like Nigeria, the DRC, Brazil, you will have places where it's very, very difficult to deliver cash. And for some of the central banks in that area, a CBDC can be seen as an alternative to that. And I would also want to see that from a financial inclusion perspective, access is not the only it's not the only criteria by which you judge financial inclusion. You also judge it by affordability and how appropriate a product and service is. And with the programmability of funds on blockchain, those aspects, customization, become a lot easier and cheaper to deliver to the end user. And I will stop here because I think I've touched on financial inclusion. I think the World Bank is probably more suited to take that standard on.
Thank you. Thank you very much, Anka. You said a few interesting things that I'll follow up later about risk-free, safety, or how quickly and efficient are transactions and so on. But I would like indeed to go to Maria Teresa and ask her about the financial inclusion. And in particular, I mean, how CBDCs, digital assets, or more broadly, if you want, blockchain technology, can facilitate financial inclusion. Because, I mean, if you see some data, I mean, there are about 1.7, 1.8 billion underbanked or unbanked people around the world. So how CBDCs can contribute to this financial inclusion of these people?
Thank you very much, Apostolos, for the question. Thank you very much, Anka. I would say that you just said something that I also wanted to reply on the issue of the market failure. So yes, it is good practice to just assess the market failure and then take that as a justification for public sector intervention. At the same time, I think we are in a specific situation where digital forms of money are going to take a stronghold, and that provides an additional justification for at least exploring CBDC, as you mentioned, which must be on the radar of central banks. So fully agree on that. On the questions of financial inclusion, so indeed, I plan to address that. But before doing that, let me just explain a little bit the framing of CBDC for within the World Bank. Now, the World Bank is contributing to global efforts to explore CBDC, specifically to explore how CBDC can overcome the outstanding issues in private sector development, financial sector development, And these include access to finance, competition, the integrity of the financial system, and so on. And so we do know, as Anka mentioned, that there are countries that lag behind in this kind of standards. Now, at country level, the drivers can vary, and this was explained very well by Peter, by also referring to the BIS data. I would say one big bucket is the bucket of preserving the role of public money. So that's one big driver of exploring CBDC. And on the other hand, you have the issue of how do we enhance the national payment system? How do we improve the efficiency of the national payment system? At the same time, we do know that CBDC, this was not the topic of today, so I'm not going to really talk about that, but there are certain risks, and these risks need to be assessed against the drivers and against this disadvantages or perceived advantages of CBDC. And for this to happen, there needs to be a very rigorous and thorough decision-making framework. And I do appreciate, we mentioned this, that the decision to issue CBDC may ultimately be driven by strategic consideration. And we talked about the strategic autonomy in the field of payments. I think that's a very important one. So this is a multidimensional decision-making process. But I think from a payments perspective, the real issue is whether and how the CBDC fits within the reforms of the national payment system. And here, I would just say that the World Bank just put out a guidance earlier this week that looks at 5 fundamental questions for undertaking this decision-making process for issuing the CBDC and understanding the role the CBDC would have within the national payment system. But now coming to the question of financial inclusion, which I think is, Anka prepared the stage for this. Now, CBDC is a potential to bring financial inclusion gains, but it's not a panacea. And at the end of the day, it will encounter many of the same issues that traditional models had in reaching and serving unbanked customers. So if you look at the key outstanding reasons for financial inclusion, and you mentioned the data, so the data is clear, but if you look at the key outstanding issues, so you have that the cost of serving this type of customer is very high. For example, as a result of limited possibility for cross-selling. So that's one. The second one is the fact that these customers find it expensive to access financial services. And another important reason is that some of these customers actually do not find any value in accessing financial services. So a bit of the auto-exclusion situation. So if you look at CBDC, actually it does not address any of these issues by itself. And the international reference framework for improving financial inclusion remains valid. And there are certain solutions that have been tested that work and should be not set aside. And these include, for example, simplifying the compliance processes or making sure that non-bank payment service providers can access the payments market. These are solutions that would contribute to financial inclusion in the longer term. Now, looking at the question from another perspective, so I need to be comprehensive here. So if you look at the question from another perspective, so then it is very likely that CBDC as a new form of cash and a legal tender will increase the attention of the central bank towards financial inclusion, the attention of policymakers towards financial inclusion for a simple reason. And this reason is that it creates even a more pressing obligation for the central bank to make sure that CBDC is accessible to anybody and everywhere. And no matter the model, so we can have a wholesale retail, one tier, two tier, or hybrid. The responsibility of the central bank does not stop at issuance. It would proceed to efficient distribution, either an expansion of use cases, either counting on its own resources or through third parties. And this, in turn, translates into emphasizing specific, I would say, design choices of CBDC. So we expect that when it comes to financial inclusion, certain design choices would matter more. And so this includes the cost of onboarding, the cost of transactions, the level of privacy and anonymity, the remuneration, and possibly also, and I would say very important, the possibility to undertake offline transactions. Now, interoperability is another important one. On this, CBDC should allow moving funds from CBDC wallets to bank account, e-money accounts, other forms of digital currencies, irrespective to anyone, irrespective of whether they use or not CBDC, and across all type of transaction channels. And this brings me to my final point and back to the issue of drivers. So we discussed a little bit the new forms of digital money, and clearly the possibility to move user preferences away from destabilizing new forms of digital money is a key driver of CBDC, as mentioned before. But in this scenario, CBDC would not only provide a way to preserve monetary sovereignty and financial stability, but also make sure that public money is suitable, it continues to be suitable. However, I want to be clear here that this objective should not detract from supporting private sector initiatives, and brings me back to the point of integration. So CBDC should be well integrated with existing systems, existing instruments, and existing payment schemes. And this would be important for financial inclusion. And this holds true particularly when it comes to very well tested and implemented solutions. Take the case of fast payment systems. So to conclude, from my perspective today, CBDC, I would say it's neither necessary nor sufficient condition for financial inclusion. Yet, I think, going back to the point that Anka made, there are a specific set of challenges before central banks that require or that require exploration of CBDC, because CBDC might have to be considered as a means to ensure the continued role of public money and the trust in the financial system, as well as interoperability, as we mentioned. And this consideration should be guided, as I mentioned before, by very thorough decision-making process. And I would say in that context, CBDC or financial inclusion should be considered almost as a built-in feature of CBDC. Thank you.
Thanks a lot, Maria Teresa. I mean, you mentioned at some point digital wallets, and there is no better opportunity than go to Paul from Nobi. Nobi is a digital wallet, but you can say a bit few more things, Paul, on that. And in particular, what are the challenges? What are the risks from a consumer perspective? Please, Paul.
Yeah, thank you. Thank you very much. It's great to be here today. Thank you for hosting. I also just want to echo comments about the quality of the paper from Peter and Thomas. Congratulations on your prize. I mean, I don't know about many of you, but like, I think there's a potential risk of CBDC report fatigue at the moment, but I would say for those who haven't read the paper, please go and read it because it's an absolutely fantastic addition to the debate. So really, really good to see that. I mean, I will get to your point in a moment, but let me just contextualize to say that the future of digital money and why we're here today is a really important topic, and it's great to have forums like this to discuss these key topics and ideas that we're here to do today. So to start, why is it that Meta cares about this space, and what are we doing with Nobi? So Nobi is our in-house fintech business unit, and our mission at Nobi is to empower everyone everywhere to access the world's financial system to accelerate financial inclusion and economic empowerment. So to that end, we've built the Nobi digital wallet, as you've mentioned, and the initial goal of that wallet is to allow people to pay one another for domestic or cross-border transactions using assets like stablecoins that will enable them to leverage new infrastructure, which is interoperable, cheaper to use, secure, and built on top of blockchain-based payment rails. So turning to the consumer perspective, which is what you mentioned, so what does this mean for consumers from an actual use case in terms of making payments today and in the future? So as I mentioned, Nobi's goal is to provide a cheaper means of making payment in the digital age. Now, one of the drivers behind that is the current the challenges that exist today in the market. And namely, you can see that either in the cost of sending remittances internationally. So I think the current average is still around 6.5%, but I think it's important to recognize that those percentages do wildly vary depending on which remittance corridor you're talking about. And also that 6.5% is way ahead, or way above, I should say, the target of the UN Sustainable Development Goal of 3%. So we've still got a long way to go. And thinking about it from the EU market perspective, I mean, the latest data from Eurostat for 2019 highlighted that I think roughly about 53 billion euros were sent in outward bound remittances from the EU. So, you know, we're talking substantial amounts of money with quite high fees, where there's a lot of opportunity to find new ways of payment to make it cheaper and more affordable. The analogy we use internally actually in this space is thinking about the cost of communications and kind of like the revolution of how the internet has transformed the way in which we send and receive messages and the costs involved. I still remember when I got my first mobile phone, you know, getting my £10 top-up card and trying to work out how I could eke out that £10 over 100 text messages. You know, that's night and day where we are today with telecommunications. And I think we at Nobi feel that there's a real opportunity to try and replicate this trend in sending and receiving money. And how can we leverage new technology to make that an easier process? So today, just to clarify, Nobi is not operational in the EU, but we have just launched a pilot version of the product in the US and Guatemala, working with a US stablecoin issuer, Paxos, the US dollar, which is regulated by the New York Department of Financial Services. And that's something we're in early stages of testing at the moment. You mentioned about like what it means from like a consumer protection angle. And I think this is quite topical in the broader debate around MiCA in terms of redeemability of, you know, the stable coins they are using. So in the context of Nobi, for example, in the pilot that we're running, we're providing a guaranteed one-to-one redemption. So if you you want to exchange your US dollar for a stable coin and vice versa, there will be one-to-one redemption at par, which is exactly the protections that you see that are in the MiCA text as part of the e-money tokens. But I think from a broader consumer protection perspective, like, I don't really think there is that much different in terms of how we would think about it if it was a stable coin or a non-stable coin wallet. I mean, we're still talking about, you know, the appropriate onboarding and KYC identity verification, ensuring that we have the appropriate AML and counter-terrorist financing systems in place. And then it's about ensuring that the customer can be assured of what it is, the store of value they have, and can they redeem what it is that they initially purchased with us. If I'm conscious of time, but if I could just turn briefly to the debate on CBDCs in terms of why we're here today, I've just got a couple of comments I'd like to throw in into the mix as well. So I think it's really important to contextualize this debate in the broader sense of the future of digital money, in the sense that there is this private conversation and there's a public conversation, whether it's CBDCs or it's stable coins. I do feel at times there is a slight danger that we slip into an either or situation where we're talking about, do we want to see a CBDC or do we want to see stable coins? And actually, I think the real focus is actually thinking about, well, what does the future ecosystem look like around the potential mix of these options? When you think about the role that private and public innovation has had in the development of payments in Europe today, I think that's kind of probably a trend that will continue, whether it's CBDC or stable coins. And if I could borrow Peter's framing actually in terms of like the market failure point, which I really like, you know, why did stable coins really take hold, or at least in our mind, why do we see the potential in them? Well, it comes back to my point about cross-border payments, which is that from a user perspective, it feels there is a lot of potential still to create better user experiences, both in terms of cost and settlement time. And I think that's kind of where stablecoins really showed potential value, in that they are a solution to a specific pain point in the payment sector today that has been around for a long time. And this is a potential new technological innovation which could potentially rectify that issue. In a former life, actually, when I used to work at the Financial Conduct Authority in Innovation Division in the UK, we actually saw this up close with a number of firms who would test blockchain-based and crypto-based remittance-type products. Now, admittedly, this was 4 or 5 years ago when the technologies were still, I could say, less mature, but they proved that there was a real use case that actually using this kind of technology for remittances could actually be done so in a way that could actually deliver a lot of value. I think what we're seeing now is kind of like the results of 3, 4, 5 years of additional innovation and technological maturity in this space. So I think to conclude, it's about retaining focus on what the outcomes we're seeking to drive for consumers, whether that's about for a CBDC or whether it's for private forms of innovation in this space through stablecoins. And that's about ensuring reliable, quick, and secure payments. I think that really should be one of the driving sort of goals from a policy perspective. And to that end, we are supportive of the efforts of central banks around the world to develop CBDCs so they can and consider this innovation. We've no specific plans to introduce a CBDC in the Nobi app ourselves right now, but we're paying very close attention to developments in this space. And the very final point I'll make, because it's just something I thought was really interesting in the paper, was on the national versus international dimension of CBDCs. And the reason I say that is because I've just been talking about the use case, or at least we see a potential use case of cross-border payments, is how that then transfers into the CBDC context. And I think there's a real question here about, are we designing a domestic retail new form of payment, or are we actually thinking about the wider real pain use case of cross-border payments today, which is actually where a lot of this whole original kind of like stablecoin conversation came from. And, you know, I think we've seen some interesting work coming out of the likes of the BIS in terms of different options for international compatibility for CBDCs. But I do worry that there's a risk that the international sort of cross-border component gets downgraded in the focus on the domestic centricity of the debate. And I think that's a really important thing that I would encourage regulators and policymakers to have in mind going forward. But I'm conscious of time, and I can see there are plenty of Q&As, so I will pause there. Thank you.
Thank you very much, Paul. You touched very interesting things, cross-border payments, also you about investor protection, but also the importance of national, international dimension, and also in terms of regulation, how this will evolve over time. We have different, regulations at national level. There is no coordination, harmonization, but we have 10 minutes left, and I have a lot of questions also in the Q&A, but also my questions that I would like to ask you. So I would like to ask you to be very briefly, just 1 minute answer. And I have a question to start with Peter. There is a question by Ignacio Angeloni about CBDC as backstop for stable coins. And the question is, if CBDCs act like a backstop for stable coins, wouldn't this change stable coins to something different? They would be subject to reserve requirements at the central bank and possibly receive lending of last resort. This would make them safer, but in a sense, they would become like a bank. Hence, they should be regulated as banks. Do you agree? What is your view on that, Peter?
Yeah, of course, the dividing line between stablecoin intermediaries and narrow banks is not very clear, because both promise a depositor that they will get the money back. And so in my view, from a kind of legal perspective, I do not clearly see why these entities should be treated differently from regulators. And yeah, so I think that's maybe something which has not been discussed sufficiently. What is the difference between stablecoins and banks, and what would justify then a different treatment? So I must say that the DM proposal by Facebook, in my view, that comes almost close to a bank. And from a kind of consumer protection perspective, in my view, it should be treated like a bank. But I think that's quite open discussion so far.
Yeah. Thank you, Peter. I have a question about Joachim. One question is about, or maybe to everybody, but Joachim as a commission also. One question is about regulation of crypto assets. How should crypto assets be regulated? I mean, we treat crypto as different because it's new, but at the end of the day, it's just, like an improvement into the system. We should treat them as an equity, as a commodity, as a normal asset. And then the question is, we already have a regulatory system for that. Do we need an extra regulatory piece, let's say, for crypto assets? Joachim.
Well, if you look at what the Commission has proposed last year, when we proposed the package that includes MiCA, but also the sandbox and other things, I think it's a very clear approach. What we've said is that basically, if you take the world of tokens, that includes payment tokens, utility tokens, other things that are possible and that are being regulated by the proposed MiCA regulation. This is not financial instruments, it's not MiFID. It's a lighter regulation. It has a lot of exemptions actually under Article 4, including NFTs, because tokens that are not fungible are excluded. There's a big discussion about DeFi, to what extent it is included, other things as well. And for those that are included, there's a passport if you send basically a white paper to your national regulator, and then you get the European passport. This is regulation extremely light. And in my opinion, this shows that we are very much pro-innovation, that we take a risk-based approach, but in most of what we're discussing here, there is no risk, at least in the decentralized solutions. And I'm very strong on this point, actually, which I'd like to hammer into everyone's minds. The systemic risk is elsewhere. So I think this is a very important signal also to regulators, because if you see what happened since we proposed MiCA, we had a discussion on DeFi, we had a discussion on NFTs, we have a discussion now on DAOs, we have the metaverse coming up, etc. If you look at that pace of innovation, you will not be able to make a new piece of regulation for each and every innovation that is coming on the market. And this is why I say that the regulatory framework has to change radically. And this is what we actually proposed. We proposed a completely new approach, and we said that for existing regulation, we make it usable also for blockchain and for tokenization. This is why we changed MiFID and a few other things. But as such, the approach as regards crypto needs to be, in my opinion, completely different than on that, for example, for financial instruments. This is my personal opinion. It's not the Commission speaking here as a whole, but I think that what we've done on MiCA has shown that very clearly. And regulators that do not understand that will be outcompeted very soon by a lot of what we've heard now of what is happening in the world. And then the cost for them is basically lost. So you have to adapt or you're out of the market.
Now, one quick follow-up question, Joachim, because also you are coming from DG Grow, you've done a lot of work on access to finance and so on. My question is, can and in which way digital euro, a CBDC, be useful in small businesses and households, especially at times of economic downturn, like the pandemic and what we experienced the last 2 years? Is there a role there for digital euro?
What SMEs, what startups, what industry need is programmable money. And for that, they have a lot of alternatives. And there are two reasons, and in my opinion, only two reasons that can make a case for digital euro. The one is that the large majority of SMEs are risk averse. They simply give greater credibility if it is called euro than it is called something else, which might play a role here. The second is interoperability. You will have to make sure that all the decentralized solutions at one moment in time will have some form of interoperability to come together, and here euro would have advantages. But that still leaves open the big question that we have been discussing here, which form of a digital euro that would be. And I see the future in a wholesale euro. I see the future in very targeted approaches by those banks that have understood and other financial intermediaries what blockchain is about, and less by centralized solutions like perhaps the retail CBDC.
Okay, perfect. Thanks a lot. I have another question about probably Anka and also Paul, but also Maria Teresa. I mean, we discuss about, and you mentioned some of the examples of digital assets. They make transactions easier, cheaper. We have open free market data, transparency, they reduce risk, and so on and so forth. All these elements are important. But if they invest in cryptocurrencies, in crypto assets, they will not mention any of that benefits, any of that elements. They will say, I'm doing it because I want to get rich quick. So how do you have been successful to inform households, retail investors about the risk, about the challenges of crypto assets? What do you comment on that? Any of you, if you want to, Anka, please.
I'm happy to start. I think I would want to make a very clear differentiation between assets and currency, whether they're crypto or not. And I think it's important to have that in mind. For me, the world of crypto currencies sort of is split into the trading, and then it's split into use cases. And those are very different worlds that coexist. They don't exist only in cryptocurrency, they exist in currency, in fiat currency, when we're looking at large FX trades and so on. And so, again, those are very different arguments, very different end users. I will push back. I don't think that get rich quick is what, part of the reasons folks use retail cryptocurrencies. Paul mentioned a very important case, which is cross-border payments. The reduction in fees, the ease of usage there is a huge value proposition. In addition to that, you'll see that, for example, the use of Bitcoin, who it's probably closer to an asset than a currency, but I'm not going to take on crypto Twitter on that. In Nigeria is actually used to settle wholesale transactions between China and Nigeria because of the difficulty of the FX trading between the two currencies. And so this is a very concrete use case that has very, very little to do with, are you going long or short or on the price of anything. I'm going to stop and let the others pitch in.
I don't know if Paul wants something to add on that.
Yeah, just a couple of quick comments. I guess I would say that I think there's increasing consumer research actually around attitudes around investing into crypto, which is showing that attitudes are starting to change. And I'm familiar with at least a couple of pieces of research highlighting that consumers are starting to see it less as a gamble and more as a speculative investment and sort of recognizing what's at stake. I think the other point is differentiating between the types of tokens we're talking about here. The likes of Bitcoin, for example, versus stable coins, which are derived for payment purposes. And I think that's why MiCA will actually be a really good development, because once you create this regulatory framework across the EU, you'll create this sense of bringing innovation inside the regulatory framework, And maybe that's when you'll start to see more like widespread adoption of these types of payment methods once they are regulated in a way that they're not today across the EU.
Thank you, Paul. Coming to Maria Teresa, I have a question also from Richard Parlo on the impact of CBDCs on financial crime, fraud, forgery, money laundering, corruption, and make it link into also the impact to financial stability or monetary sovereignty. What is your view on that?
Okay, let me just for a second come back to the point that you just asked. I mean, from a financial inclusion perspective, I think I wanted to chip I wanted to contribute to that discussion as well. So I would point to three things. So one, when it comes to let's see, this forms of digital money. So the number one question I would say is how to safeguard consumer funds. So what are the specific tools that authorities have to put in place certain safeguards? Be that through supervision or other type of tools. So that's the first issue: safeguarding customer funds. Then the second one would be from a financial inclusion perspective. Again, we mentioned reducing fees and the speed, but there's also implication to for cost implication for cashing in and cashing out. So to the extent that specific means of payment or store of value cannot be used in the economy at large, then that would impose certain costs on the consumers that need to be taken into account. So that's another consideration. And the third consideration that I would make is also regarding disclosures. So when that specific forms of money is used as a means of payment, the service provider needs to be disclosing the risks that are associated with it, the credit, the liquidity, the operational risk that he bears and that consumers bear in using that product. So that was my contribution on that. On the risks, I mean, this is a huge topic. So what I mentioned initially in my remarks, perhaps, is that there are a number of risks that need to be taken into consideration. The risks can be addressed through specific design choices. There are trade-offs that need to be taken into consideration, but those can be addressed. And I think the position of the World Bank is clear that there is a specific point in the paper that I mentioned that talks about be neutral, meaning that be neutral in the sense of making sure the CBDC is a list that complies a list with the same level of that has the same level of compliance as other payment instruments out there when it comes to integrity, money laundering, and financing of terrorism. So that would be my short answer, but I'm afraid it's very quick and would deserve much more elaboration. Thanks.
Thank you. Thanks, Maria. Before closing, we're already 3 minutes past. Just last remarks, 30 seconds, each of you, your last point, your last thing that you want people to keep from today's discussion. Please, Peter, 30 seconds. What is your key message? Unmute yourself, Peter.
I'm somewhat surprised that the idea of European PayPal has not been discussed more intensively, because PayPal is easy to use. It is very contributes to financial inclusion, and you can easily make international payments, maybe with relatively high costs. But if you have a European competitor to PayPal, you can also reduce the cost. So I think this is a centralized solution, which I think is very important for European autonomy, and it should be discussed more than it is today.
Good. Thanks a lot. Joachim.
2 remarks. First, I think that the European perspective in terms of competitiveness that Peter has just raised is very important. For me, it is in that context more important to lay the fundamentals, to see what, for example, we do in the context of EBSI to create an infrastructure, to look at digital identity, to look at all the enabling factors, and especially look at the skills and education dimension to have a lasting effect, and not perhaps look at short-term business models as such. Second is, I can only encourage what has been mentioned by one of the panelists, looking into the definitions and have an academic discussion on this. And this is, again, why I like the paper of Peter and Thomas very much. For me, cryptocurrencies are currencies for very good reasons. For me, stable coins are a transitory phenomenon, which is basically because of short-term fluctuations, but not more. And CBDCs are something completely different, especially in the different manners that have been discussed. And I know that this has been rather confusing at the end, but I think it is an invitation to much more in-depth discussion, because indeed, what is the most important aspect, in my opinion, of the whole discussion is getting a language which brings us together. And at the moment, I see a lot of language that everyone defines for him or herself, and that takes us apart. And that is therefore a big outcry for more research on this.
Thank you. Anka?
Thank you so much for this. I think that my main point is, regardless of the policy or the goals of a CBDC, I think it is important for every country to test, to be able to fully understand what the potential is, what the design implications are, and be able to adopt or not adopt, regulate from a place of knowledge. And I think this goes back to your last question, where currency on blockchain actually can really augment the ability to deal with the negative consequences of bank de-risking and actually impose very clear AML standards because of the immutability of transactions, and really shifting the narrative away from ransomware and all of that.
Perfect. Thanks a lot. Maria Teresa.
Thank you very much. So I just like again to thank you, congratulate the authors for the paper, and then again just for concluding and my concluding remark and my point for today. As I mentioned, CBDC is neither a sufficient nor necessary condition for financial inclusion. However, CBDC is likely to increase central bank attention on financial inclusion, policymaker attention on financial inclusion, to reinforce the central bank responsibility towards financial inclusion public objectives. And this points to a clear responsibility of the central bank, not just in the issuance space, but also in the distribution space. So making sure the CBDC would be accessible, including to those customer segments that are not currently, they may not be currently served by payment service providers. And again, also points very clearly to the role of interoperability. So this will be my point for today. Thank you.
Thanks a lot, Maria Teresa. Paul, your last words?
Yeah, thanks. And always a challenge going last when speakers have made such good points. I guess I would say it comes back to like user centricity. And, you know, just as any other kind of like product development and thinking about designing something new, how is it that we want the end users to experience it? What is the use case? Like, how do we actually expect them to interact with it? Not assuming something will be successful or not successful, and really thinking about that as we take some of these conversations forward. Because at the end of the day, a digital euro requires people to use it to be successful, and we shouldn't lose sight of those people as part of this process, especially when a lot of central banks around the world, let alone the ECB, are recognizing that CBDCs are going to require some kind of like legislative developments. This is not going to be just a technical discussion. So you need to make sure the public is also brought on this journey as part of the process. Perfect.
Thanks a lot. Peter, you mentioned about European PayPal, and it sparked a lot of comments at the chat box. But we'll pass all the questions that we received. They will send them to the panelists, and if they want, they can reply directly. But I want to take the opportunity to thank everybody, especially Peter and Thomas, for this excellent paper and the opportunity to have this webinar. Well done, congratulations to your prize. But also the panelists, Joachim, Anka, Maria Teresa, and Paul, for this excellent contribution. We already 24 past, so we ran over time. We could continue easily for another hour or so. But it's a topic that we are going to follow over the coming months. As I mentioned, we are going to have a call for papers for the regulation about digital payments and digital assets. So we are going to have the opportunity to discuss it further. So I would like to thank everybody. First of all, to say about Peter's paper, because people are asking. Peter's paper will be probably posted and be publicly available at the ECMI and SERP's websites by the end of next week. And also Peter's slides will be available at the website to use them. And with that, I would like to thank everybody, the participants, but also the panelists, for making this discussion very interesting and interactive. Thank you very much, and have a nice afternoon. Bye-bye.
Thank you. Bye-bye.
Thank you. Thank you, Peter. Thank you, Anka, Thomas.